Hello, and welcome to the special presentation for Friday, January 4th, 2019. My name is Glenn Tompkins. I'm a senior instructor here at VectorVest, and it's my pleasure to give your presentation this evening. This week's presentation is entitled, How to Make Money in a Volatile Market. Volatile market is probably an understatement due to what the market has been going through lately. Markets go up, then they go down, one day up 500 points, next day the market gives it all back. I believe, though, that VectorVest has done a great job keeping you on the right side of the market and the right side of the trend and helping you to make money during this time. And the great thing is that we've been keeping you safe during the neutral times in the market as well. Tonight, though, we're going to concentrate on exchange-traded funds, also known as ETFs. We're going to use these ETFs as a means to make money in a volatile market. First off, let's talk about what an ETF is. These are funds that work sort of like a mutual fund, but they trade like a stock. These funds can track an index or a group of stocks in one ticker symbol. Think about it. Instead of buying a few stocks in the Dow or the NASDAQ or the S&P, why not buy an ETF that tracks the whole group? That way you're going to have less exposure to risk because you're buying the whole index. In volatile markets, it's great to reduce your exposure to risk because markets are moving wildly up and down. Tonight, I'm going to show you how to build a watch list of some of the most popular bullish and bearish ETFs to trade in a volatile market. Let's get right into the software. Talking about a volatile market. The market is not closed yet, but look at the move in the market. Up 700 points in one day. So this special presentation goes right in line to what's really going on in the market and is on pace to make a good deal for you. All right? So we're going to start off from the Viewers tab. In the Viewers tab, I'm going to go find these ETFs because we have a folder in here called the ETFs. All right, under the watch list, we have a folder laid out as ETF. It's a yellow folder, so look at it as a filing cabinet. And within the filing cabinet, if I click on it, we'll see a lot of the files or a lot of the different variations of ETFs here for you. Now, with all of these different variations, we've made it easier for you to get in and out, but I'm going to explain to you what a lot of these are about. We can start off with leveraged, Contra, and regular ETFs. Leverage means that it's leverage. If the indice that you're looking at goes up or down, if you're in a leveraged ETF, it will go up or down 2 to 3%. That's 2 times or 3 times leverage. For example, let's look at a triple leverage Contra on the Dow. If the Dow goes down 1%, that triple leverage Contra on the Dow will go up 3%. Now, what is a Contra ETF? It's contrarian. That's what Contra means. It's contrarian to the market. So if that Dow or NASDAQ or S&P index is going down, you can use the double or triple leverage Contra, contrarian to the market, of either of those indicators or indexes, and they will go up 2 to 3 times faster. Now, buying into leveraged ETFs is a very aggressive way of trading the market. If you're not willing to buy or sell stock short, actually, if you're not willing to sell stock short, Contras might be a good way to go. But the leverage are a little bit more aggressive, but we're going to use those tonight, and I'm going to show you how to take some of that aggressiveness and use it to your favor. All right, so that's about the leveraged and Contra and regular ETFs. Regular ETFs go up as an index go up. Contras go up as the index go down. Scroll down a little bit. We have a whole listing of all the Contras in one folder for you. How about Direction? Those are all triple leverage ETFs, whether they're bullish or bearish. Scroll down a little bit. A lot of different companies put out ETFs as well, and here they are separated by their individual names. How about if you want to look at index ETFs, both bullish and bearish? You can look at them here. iPath is another company. Leverage, all the leverage, Contras or regulars are here. If you're not looking for leveraged, we also have them separated to non-leverage Contra ETFs, and non-leverage regular as well. There's a lot of different variations. A lot of the heavy lifting has been done so that you can easily find ETFs, both Contra and regular, in this list. So where I got started though, I said, well, if you're in a volatile market, what's going to best help you? And I decided that the triple leverage would help me more. Why? Because they are triple leverage. They're going to move a lot faster, whether bullish or bearish, in a volatile market. They will give me the most opportunity to make enough money to capture profits on those wild days. As I did mention though, they're a little bit more aggressive. But as I told you, I'm going to take some of that aggressiveness and I'm going to help it to be your friend, even if you are a position trader. All right, so what did I do? Let's start off with the 3-time leverage ETFs Contra. Now, once I click on it, it's going to return all of the 3-time leverage Contra ETFs sorted by VST. Keep in mind though, this is a watch list. And the biggest thing I want you to take away if you're looking at a watch list, especially of ETFs, scroll over and you need to go to the average volume level and change it to make sure you're looking at the most liquid Contra ETFs that are 3-time leverage. How do you do that? Go up to the average volume heading, click on it. Now, not only are we in the triple leverage Contra ETFs, we are looking at the ones that trade the most. Why is that important? Well, if they're aggressive, I want to make sure that I'm in liquid Contra ETFs to jump on board with. You'll see very quickly some of the big movers are at the top of the list, and these are the stocks or the ETFs that I used to populate my watch list. Let me break it down. If I'm looking for the triple leverage Contra for the NASDAQ, how about the SQQQQ? Short the Qs. Natural gas, that's been a big mover up and down. How about DGAS as a Contra ETF to play in this case? Small cap, TZA. On the Dow, the SDOW. All of these ticker symbols are here and they're broken down so that you can look at their names. But if you don't know, like DRIP, it says oil 3 times bear. How about SOX? It says semi-bear. I don't know what that means. All right. If you right-click on it, go down to View Full Stock Analysis Report, and from this report, you're going to get an understanding of what each one of these Contra ETFs are. Notice that before expenses, 300% of the inverse of the performance of the semiconductor sector. So we've heard names like NASDAQ and Microsoft and Google that have been moving the tech sector. So if that's the case, why not use an Contra ETF when they all go down, when those stocks go down? Why not use a Contra ETF that you purchased long? All right, remember, these are contrarian to the market. You purchase these long and you take advantage of a downtrending tech sector in one ticker symbol known as the SOX. SOX means short. An oil, DRIP. This is the bearish on oil. So I looked at these and I used the ones to cover a wide breadth of market, like the Qs, like natural gas, small caps, Dow, the S&P 500, crude oil, tech stocks. Notice that I've got 2 here for oil. I picked one of the 2, one that was traded a little bit higher than the other. Financial, gold, biotech, the Russell 2000. And I use these ETFs to combine and make my watch list for the bearish side. So I'm going to go up here a little bit. I'm going to go down to ETF Pairs. So I showed you what I did. I went to the triple leverage, sorted it by average volume to bring the most heavily traded Contras to the top of the list, triple leverage Contras. I created a pair ETFs. And from here, these are the ETFs that I have in there. There's 11 of them. The SDOW, the FAS, or the Financial Bear, the SPXU, the Russell 2000, small cap. Again, the techs, the Qs, the biotech, oil, gold, and natural gas. Now, could you add more to it to encompass more breadth of the market? Sure you could. But these 11 I found seem to capture a nice wide breadth of the market, covering just about every major sector in the market to take advantage of. And this is on the bearish side. And then what I did to find the bullish stocks, I went to the 3-time leverage regular and did the same thing. Because it's a watch list, the first thing that you're going to do is sort this list by average volume. Notice that if you don't do that, you may be in some illiquid volume ETFs. So first thing again, sort by average volume. This puts me in the most liquid ETFs, in this case on the bullish side, because these are regular ETFs. And I found the backups or the pairs to all of the ones that I picked on the bearish side. So if I scroll back up again, bull pair ETFs I just took those stocks and put them into this watch list. I built my watch list. Don't worry, folks. At the end of this presentation, I'm going to give you a full listing of both the bullish and the bearish ETFs that I've used. And again, these are all triple leverage, but in volatile markets, you want that triple leverosity to go. That's a Glenism. You want that triple leverage to go along to make your money quick and take your profits fast. And I'm going to show you how to limit your losses as well. So here's my counterpart to the bear pair ETFs, and here's my bull pair ETFs. Now that the watch lists have been built, the next thing I need to do is build a search around them. So I went to the Unisearch tool, and real quick, I've already got them built, but I'm going to show you a couple of things that I added to ensure some safety to a certain degree in this search. First thing you do, you go to parameter. Under parameter, go to stocks. We're going to filter by a watch list. Okay. From here, under operator, equal to. When we go to value, all of my watch lists will show up. I only want to click the plus sign in front of the ETFs, not the whole box. That will check all of them. I don't want them all checked. So don't check the box. Only use the plus sign right in front of where it says ETFs. That will open them up without checking them all. Notice that I have my bull and bear pair ETFs already here. I'm going to start off with the bear pair ETFs. Check that box. None of the other ones need to be checked. Very important. Click on OK. It now is looking at, this search is only looking at the bear pair ETFs. Now, this is where the little twist comes into play. Let's go under parameter. What's important to me when I'm looking at a stock, or better yet, even an ETF in this? I want to make sure that the ETF is moving higher, right? Let's go to stocks. Let's go over the capital appreciation. I'm going to make the RT, make sure that when it buys, the RT is greater than 1. So now not only am I looking at the bear pair ETFs, if the market is going down and these now show up, I want to make sure that they're rising in price, so RT has got to be above 1. But wait, there's more. Let's go to the sort. Let's change the sort from VST. Move this over. Let's change the sort to make sure that the stocks are really rising. We'll click the drop down arrow. We're going to hit the drop down arrow. We're going to go find us RT times CI. Stocks that have a good RT times CI, which is comfort index. In essence, these are stocks that go up more than they go down. CI tracks the stock's ability to withstand long or lengthy price declines. So if a stock does get hit by way of CI, high CI stocks tend to rebound and continue moving faster to the upside. So good RT, good CI, coupled with that the RT has to be above 1, you're now putting yourself in a good situation with these triple leverage ETFs. All right, so this is the bear pairs, and what I've done is I saved it, and I went to both my long and my short searches. Notice that in where it says my short searches, there's my bear pairs that I saved. But if you want to save this now, click on the save icon at the top. You click on save as, and now I'm going to go find my short searches. So we'll scroll down, okay, my short searches. And I'm going to resave this again, but I'm going to call this special presentation. Oops. And we're going to call this bear pair. All right, I've already created it here, but I wanted to walk you through step by step on how to create this. Make sure you have this as a short search. Now, being that these are a bear pair, they are showing a down arrow. I have to let you know, these are Contra ETFs. These are ETFs that you buy long. Remember, they're contrarian to the market. So when the market goes down, a Contra ETF goes up in value. You never short a Contra ETF. You buy it long. And the reason why it makes money is because it works the opposite of the market. I'm going to now click on OK. And the one that I just created that says special presentation, bear pair, I now put that in here, but I already had that there as well. Again, I wanted to walk you through step by step on what you would do. I've also created in my long searches the bull pair ETFs, which also has the bull pair ETFs as a watch list and relative timing above 1 and the sort of RT times CI. Folks, that is the key factor to making sure that no matter whether you're bullish or bearish on these triple leverage ETFs, that you're buying into stocks or ETFs that are rising in the current market's condition. So if I'm looking at volatility, these are going to start to pop. And when they do, they will populate in your portfolio. So now I've taken this a step further. Now that the watch list has been created, and then we've taken that watch list and built the search around it, the next thing I had to do is test it. So let's go up to the back tester. Now I did 2 tests. I did the bull bear pair on their own merit with no stops. So the bull pair, when we had an up call, and in this case we were using the primary wave, of which I'll talk about in a second, and when you get a primary wave down call, it went with the bear pair. But no matter which pair it went with, RT had to be above 1, and they were sorted by RT times CI. So now let's take a look at the first one, which was tracked over the last year from 1/3 of 2018 to 1/3 of 2019. I'm going to simply click on edit. As you built this, I named it bull bear pair. All right, my account settings are set up to a $100,000 investment, pay commission of $4.95 per trade. We're not using margin or accounting for interest. We are executing the buys and sells at the next day's open. We will execute the test in daily pricing mode. All right, so that is the account settings. Now I'm going to go down to customize the trading system. What I'm using is the primary wave. Why? Because in a volatile market, you have to be like a cat on a hot tin roof. You've got to be able to move at the sign or the drop of a dime. On those big swing days, you need to have a fast timing signal to effectively take advantage of the up and down markets. The faster the timing signal, the more responsive you will be to a market's move. All right. Next, let's go to automation rules up. What are we doing? We are buying long, and the search that we're using was in my long searches called the bull pair ETFs. Remember, that's where you saved it. So simply I would go to my long searches, go to bull pair ETFs, and now I select that search. My stop criteria on the base test was none. I wanted to test it on its main merits on its own before I did anything else. More settings. I started off with buying 10 stocks, or whether it's on the up or the down, buying 10 stocks, automatically replacing, and I kept everything the same. All right, I didn't change anything. Let's go to the rules down. Remember, these are Contra ETFs. Very important. Don't get caught out there. You're buying them long. For any of you who are not comfortable shorting stocks, this is a great way to take advantage of a downward trending market in a volatile market. I'll talk more about other ways to use this methodology in this presentation as well. But you buy long on these Contra ETFs. And again, I showed you how I went for the high average volume ETFs, both on the bull side and the bear side. Stop criteria, again, just as a base test, no stops. More settings, 10 stocks automatically replacing. Again, I didn't change anything else. I'm going to click on finish. The first thing you're going to notice is look at that equity curve. Mamma mia, that don't look so good. And the first question that's probably going to come out of your mouth is, why in the world would Glenn show this kind of performance? Well, it opens up a couple of things. One, a fast timing signal seemed to work. Well, sort of, kind of. Very responsive. but it also opened up the idea and told me that money management was crucial in this scenario, especially being that these are triple leveraged ETFs, whether bullish or bearish. So money management was extremely crucial. Now, on its own merit, with no stops over the last year, it did eke out almost a 10% gain. Look at that drawdown. Without the money management, these stocks got hit, or these ETFs got hit tremendously to create about a 30% drawdown. All right, so money management was extremely important, but on its own merit, it did make money. Now, I did some testing in the background before I did this presentation. I tested a lot of stops and a lot of different variations of how many stocks to put into the portfolio. My best combination was looking at a profit locker of a 25-8, only maintaining 5 stocks. Let's take a look at that. That one went up. Oops, let's scroll down a little bit. Bull bear pair, there we go. That one went up 42% as compared to 9.84%. We went from only having 43% winners to 50% winners. Folks, I don't care who you are. If you can invest in the market and your portfolio has got greater than 50% winners, you're good. All right, commissions dropped almost in half based on that $4.95. Did a lot more trading here when you didn't have any money management, but when you did, you drop the commissions, annualize out to 42% a year. In a year like this, year, would any of you not be happy with being able to maintain and take advantage of a 40% annualized rate of return? Not only that, look at the drawdown. The drawdown dropped down significantly. So in a volatile market, which was towards the end of the year, in a volatile market to only come up with a less than 10% max drawdown, holy smokes, does that work? And of course, I'm going to hear a lot of people saying, well, this is a back test. You're absolutely right. This is a back test. But you know something? Give me another volatile market going forward. I'm going to feel pretty comfortable using this strategy in that volatile market. So a couple of things. We did use triple leverage ETFs. We did use a fast timing signal. You need to use a timing signal like that to take advantage of all of the bumps and wiggles of a volatile market. We did only use 5 stocks because it turned out to be a better play, and the profit locker was set up to a 25-8. Let's do an edit. Let me really break it down. So the timing signal we used was the primary wave. Let's customize the trading system. On the rules up, we still use the same search, the bull pairs ETF. On the profit locker we use, on the stop, we use the profit locker 28.5. I allowed these nice runners to run in these wildly moving markets to run, but guess what? I wasn't going to lose any more than 5%. That in and of itself is a safety feature, coupled with making sure that the RT is above 1 before you buy into the ETF. That is a great way to help use that volatility and make it your friend, even if you're not comfortable trading triple leverage. I'm showing you a way to trade triple leverage Contra ETFs and regular ETFs and minimize how much money you could lose. We'll go over the more settings. We have 5 stocks that we're trying to hold on to. This is also key. Automatically replace closed positions. We are not. So we're allowing the stocks to run, take their profits, put them on the table. We'll allow the portfolio to extinguish itself until the next call. What does that do for me? It keeps me safe. Even though the volatility of the market is moving, it locks in my profits and minimizes my losses. And I wait to the next call, and then I jump again. But everything else stayed the same. On the rules down, also buying long, bear pair ETFs, stop, the 28.5 profit locker. Under more settings again, only holding 5 positions, not automatically replacing. Again, that is a key factor in this system. Click on finish again. Again, 42% in 1 year, where the year got all jackified with a whole lot of volatility. Now, look at as the year went along, this portfolio never went underwater. Could this portfolio be used in a trending market? Sure it can. But remember, we're using triple leverage ETFs. In an uptrending market, you might want to consider paring back to a 2 times or a non-leveraged ETF, since they will have more time to make money, because whether it's trending up or trending down, they have more time. They don't need to move nearly as fast as you need stocks to move in a volatile market. But notice you're going to see times where the portfolio set itself into cash. Why? Because we were not automatically replacing. We wait for the next call, and then we rock and roll again. Another level where we sat in cash. And even as the volatility, the market peaked in October, the volatility really started kicking in. Look what the portfolio did. It used the power of those triple leverage ETFs to really rocket itself up. And even when it wasn't sure, it kept you, made you money, stopped. Boom, it fell a little, made you money, and stop. You know something? I'd rather take my profits off the table and wait for the next call than to keep being in there and go, oh man, I lost money. Oh man, I lost money. This trading ideology in a volatile market did an excellent job over the last year. Again, less than a 10% drawdown. So that's it, folks. We also learned, as far as takeaways in the portfolio contest that we just got out of, volatile markets should use a more volatile and quick methodology. That's what we've done. Fast market timing for fast moving ETFs. Tight stops. Why? You get to capture your profits quick and you get to minimize your loss. No replacement. Why does that work? It keeps you safe so that you're not messing around in the market that's still volatile. Lock your profits in. You can't go broke taking a profit. This can also be used in non-volatile markets, but again, consider using double or non-leveraged ETFs, since they will have a longer time to make money, and your money management will have to be different on those as well. All right, I did promise you that I would give you a listing of the stocks or the ETFs that I took. Here they are on the bull side, on the bear side, and what indexes they covered. And notice we covered the NASDAQ, gas, the Dow, gold, S&P, technology, oil, biotech, Russell 2000, small cap, and financials. Folks, I think that that is a nice wide breadth of looking at the market and making sure that we could take advantage of it with bullish triple leverage ETFs and bearish triple leverage Contra ETFs. So here's your list. Make your watch lists. And all I've got to say is, when the market is bullish again, or actually when the market is more volatile again, folks, keep this in mind. Less than a 10% drawdown in the last year is amazing. And again, you can now make watch lists for the non-triple leverage, maybe for a double leverage, maybe for non-leverage. You can look them up right in those watch lists that we've created for you and do the same thing. So with all of that, folks, I'd like to say thank you for joining me for this week's presentation. The first of the year. How about that? The first of 2019. It's been my pleasure to do it. If you have any questions, please give our product support staff a call. And actually on Monday, we're going to be holding a Q&A. Come with your questions, folks. Hopefully I did a good enough job that you may not have a lot of questions, but if you do, by all means, that is going to be the place to get your questions answered. With that, folks, I want to say have a wonderful evening. Have a wonderful weekend. See you next week.